Hey, can you hear me?
Yeah, but you need to turn on your video. Hey, people who are here, we are just getting set up. We'll be starting in about 4 minutes. There's David, here's Verner, and we'll wait about 3 more minutes to allow everyone to join us.
Can you hear me okay? Like, is my voice normal?
Yeah, you're good.
Good, good. So no intro music after all?
I didn't say that yet.
Oh, are you queuing it up right now?
I'm doing it up. All right. Just for the people who are here, there should be a button somewhere that you can ask questions. Feel free to ask any questions at any time. We're going to get started at around 6 o'clock, so about 3 or 4 more minutes here. All right, welcome everyone. Got some more people coming in. We're going to get started in just a few minutes. And feel free to ask any questions throughout. There should be a button up there to do a Q&A, ask any questions. Make sure you can change your questions to, all, so we can all see it, participants and panelists. All right, we'll get started in just a couple minutes here, guys. Once everyone joins in, welcome everyone. We're gonna get started in a minute or two.
Do you have some people logging on already? Yeah.
Yeah, we got a lot of people logging in.
Awesome. Being that you're hosting it, I won't see the questions, right? So you'll see them and you'll pick and choose which ones you want to.
Yeah, I'll kind of stop you if it pertains, and then we can make sure we answer everything definitely towards the end.
Sounds good.
What's going on, everyone? We're going to get started in just a couple more minutes. People are still filing in. So, good question already. Do we need your camera on? No, it's just David and my beautiful faces. This evening, I figured with all the people that will be joining us, it keeps it simple, okay? So it's about 6 o'clock right now. We're going to go ahead and get started. Welcome, everyone. And if everyone can just ask any questions in the chat box, make sure you're making your questions towards all panelists and all participants. And we'll get started in just 1 minute here. Let me get my screen up. We'll just get started in a minute. Okay. And
I think you can make it full screen, right?
yeah, I'm gonna do that now. share. Where'd it go? All right, guys, hold on one second. Technical difficulties right off the bat.
Very strong start.
Yeah. Cool, we got more people coming in. We're just gonna get started.
Cool.
Just a minute here. Okay. All right, per popular demand from someone, we're going to get started now. Welcome, everyone. Thank you so much for joining us. My name is Verner Dixon, and David Boubion is here with C2 Home Lending. We're going to do our first time home buyers webinar here. So quick question I have for everyone out there. Who, and you can type it in the comment box, who is going to be thinking about buying in the next, immediately, right now? Who's kind of in the mode of buying? And then type a number 3 if you're thinking about buying in the next, 3 to 6 months. And then maybe type in a 6 if you're thinking of buying in the next 6 to 12 months, or about a year. Just kind of want to get a kind of an idea of, what people are thinking. And with that, we're just going to kind of start this here. This is geared for mostly California people. I'm a licensed realtor in California. David, you are licensed in?
California and Washington, but C2, we can help out in many other states as well.
Yeah, perfect. So this information is going to apply to pretty much anyone who's interested in buying a home. And if you are from another state or not necessarily in San Diego, definitely still reach out to us at the end of this, and we can definitely help you out and point you in the right direction. So with that, we're going to get going. So who are we? I already kind of said my name is Verner Dixon. I'm a realtor. I'm with Pacific Sotheby's International Realty. I've been helping people for a long time. This is my passion. And David, go ahead and introduce yourself.
Yeah, David Boubion with C2 Financial. I've been in this business for about 18 years now, and focusing on the financing side with C2 for about the last 3 years. Pretty much it.
Cool. Perfect. So let's go over today's outline. We're going to go over your loan, all the income requirements, credit score, down payment, etc., and all the loan options that are best for your first-time home buyers. Then we're going to kind of go into the current environment. COVID-19 has definitely affected a lot of us and the way we do our business. So we're just going to kind of go through how that has changed. And then we're going to walk through the whole home buying process from start to finish. Like, what does it look like when you're looking for homes? How do you put in an offer? What does escrow look like? And when do you finally get your keys? And then we'll follow up with a bit of a question and answer period where we'll just kind of go over any loose ends. Okay. David, take it away.
Okay, sounds good. So this is pretty self-explanatory. We'll start off with, we'll break it up into these 3 different sections. Part 1, as you can see, we'll do qualifying. Part 2, the loan programs that you would use to qualify. And then in section 3, we'll just do some of the credit basics. A lot of this stuff most of you will know, but hopefully it'll be informative, or just base your questions around some of these areas, and we'll try to answer as many as possible, or all of them, really. Okay, do you want to switch over? I think the next slide, Verner, has you. So we'll start off with income requirements. This is a common one that I get from everybody that I talk to at the beginning of the road. What do I need in terms of income to be able to qualify? These are some of the easy templates that we use. So 2 years of consistent employment. It doesn't have to be at the same job itself, but it does have to be within the same field. So if you switch fields entirely, it can create a little bit of an obstacle. Basically what a lender wants to see is that there's some stability in your employment. Okay, so you can easily make the payments if you've had stability you're likely to have stability moving forward too. The second bullet point here is we have to go off of the income that's on your tax returns. Sometimes you have service workers who don't show everything on their tax returns, or different fields, or business owners who can take many deductions and so forth. We have to go based on what's on your tax returns. There is one exception. There is a slight exception that can apply to business owners. But for most people who are W-2 employees, this is what we'll go off of. Third tier there, provide proof of your W-2s, or with your W-2s, 1099s, pay stubs. We need to look at that documentation just to show, again, that you've been receiving the income for some time on a consistent basis. And lastly, you'll see there, no cash accepted. So a lot of times people have cash, we used to call mattress money. Cash that's not in the banking system. Even if you do have some cash, if you're planning for some of the people, for example, that wrote that they're looking to buy in 3 to 6 months, and you do have some cash reserves that are in actual cash, getting into your accounts is important and part of the planning process as well. Click it. Okay, so the second item here, this is a big one. This is the easiest way to understand it. Debt to income ratio. Okay, so it's the percentage of the household income compared to your monthly expenses, including the new mortgage payment. So what we do here typically is we'll add up what the new proposed payment is going to be. Most people have an auto loan, some credit cards, personal loans, student loans are big as well. We have to take that whole picture into account when qualifying you for a mortgage. The easiest metric to think of is 50% of your gross income. So if your gross income is for the entire household, if you're a married couple, let's say the household brings in $8,000 a month, your max debt to income ratio at 50%, you would be looking at all of your monthly expenses at $4,000. Okay, so if your total income for the household is $4,000 gross, $2,000 is that figure. It gets a little more detailed, but for our purposes now, 50% is an easy way to understand it. On some, you do have to have, for what we're referring to here on jumbo loans, those are larger loans, anything in San Diego County above $701,000 loan amount. That ratio changes to 43%, but for our intensive purposes here, for first-time home buyers, typically think of 50% when you add all those together. Let me click on the questions here, see if anyone, okay, we're good. Okay, so credit, your FICO score. Most people have a general idea what their FICO score is. Many people get these monitoring systems through your credit cards now. You have access to your FICO score or your credit report one time a year on annualcreditreport.com. Your credit score is a big part of the qualifying process and also just applying for credit of any sort. So we have to use the mid score. So you typically have 3 credit scores. We have to use the mid score for qualifying. Okay, so you remove the high, remove the low. Your mid score is what we use for underwriting in the mortgage world. We also have to take into account if you've had any kind of bankruptcies, foreclosures, short sales. That doesn't mean that you don't qualify, so definitely still inquire. There's just different waiting periods for those different events. So easy template for bankruptcies. It stays on your credit 7 years, but sometimes you can buy a home even 2 years. For Chapter 13 folks, even when they're in Chapter 13 bankruptcy, there are some programs where we can help them in purchasing and refinancing as well. FHA and VA, if there's any veterans out there or either active military or veterans now, outstanding options for veterans. We do a lot of VA home loans and refinances as well. But FHA and VA are known for having more lenient guidelines, so they make it easier. FHA can allow for a lower credit score, VA as well. A little bit of that has changed in this current climate, but ultimately very good programs for first-time home buyers. Next one, must show overall responsible use of credit. Obviously, if on the credit report there's a lot of collections, derogatories, or what we call them, derogatory events or accounts, we need to address them beforehand. Sometimes medical collections show up that people aren't aware of. So part of that process now, if you're just beginning, is taking a look into your credit report to find out if there's anything on there, one, that needs to be addressed, or two, that maybe you weren't aware of. Because the responsible use of credit is a large component in getting your first place. And yeah, the last one, we can help with improving credit scores. The credit formulas, the way that they come up with your FICO score, let's say if you're aware that you have a FICO score of 680, there could be some potential tweaks over a course of a couple months or a few months that we could make to your credit in terms of maybe paying down an account a certain amount, or maybe disputing an account that is incorrect, and making sure that when we go into the underwriting process, you're not entering into that when, let's say, when you find the house that you want, there's no surprise there that you need to fix immediately, because credit is not something that is fixed right away. Sometimes it takes 30 days, 60 days for it to report. So another reason we'll touch on here in the next couple of slides why it's important to tackle this stuff early before you actually go out with Verner or anybody else to look at properties and to make offers. Okay. Now, another big component is the cash to close and your down payment, right? That's one of the main questions people have. Cash to close is considered your down payment plus any kind of closing costs. Anytime that you have a real estate transaction, there are different third parties, like a title company, an escrow company, the county, in our case, the County of San Diego or LA County or Orange County, that have recording fees as well. So all of these are part of the closing costs. What we do as a lender, I'll get into that more later too, but we can even offer you lender credits to cover a lot of these. Verner can attest to this, helped a lot of his clients in the past with lender credits to cover a good chunk, if not all, of the closing costs as well. But it's case by case. We have to figure it out based upon your rate, credit, and so forth. The other side.
And real quick, a lot of my clients have used David before in getting their loan, and this is not like an advertisement for David, but he is a fantastic.
Oh, it's an advertisement.
Yeah. Fantastic lender, and if you compare apples to apples, he's almost always able to get the best rates, the best loan options, and helps the most people. So I'll go with that being said.
Yeah, thank you. Okay, so the other side here, the down payment. This is another big question everybody has come in. 3%, this is what we typically see from first-time home buyers, is within this range. So if you have 10, 20% down, fantastic. That's great. A lot of times, as the way to get into home ownership, there are outstanding programs such as that allow for lower down payments, like 3 are some conventional loan programs. 3.5 is what you typically see for FHA. We mentioned that on the previous slide. That's a government insured loan. And then 5% down, there's conventional programs as well. That one is, I would say 3.5 and 5% down are the most common that we see. 3% is a smaller window. You have to meet certain guidelines for that, but it's a good metric. Even if you're just starting to plan and think about buying a place, 3.5 or 5% of the purchase price is a good goal, because that can get you there. Gift funds are allowed. This is a big one too. Many people have parents, grandparents, anybody else who's willing to supply gift funds. You can use gift funds from what we call a donor. Let's say if your parents want to give you 3.5% or 5%, that is allowed on many first-time homebuyer programs. We just have to document it. So if that's going to be the case, you let me know. I'll let you know what the proper protocol is to get that sourced and verified, which is the last section there. We need to know where it's coming from. Banks need to find out where it's coming from, and also verify from that source. Let's say if your parent gives you the money, your parent would also have to sign a letter stating that they did in fact give you the funds to put as a down payment. Any questions or anything, Verner? Can you see or?
We'll go over questions as soon as you're.
Okay, keep going. Sounds good. Okay, so here we go with, let me clear this out. Okay, I touched on this a little bit earlier, but loan programs, conventional, the two that are a bit of a niche product, but people who can qualify for it, it's outstanding. It's one of my personal favorites. The Home Possible and Home Ready programs. Google it, check it out in your own time too, or if you want to talk to me personally about it, I'm more than happy to give you the info as well. But Home Possible and Home Ready do have income limits, but this is a program that allows for 3% down. So the eligibility is determined by your zip code and your income. So there is a cap on the income that you would make. Therefore, there is a cap on the amount of loan, the dollar size of the loan that we can provide under these programs. But if you are in the, let's say, 250,000 to 400,000 range in loan amount, Home Possible and Home Ready are excellent options. FHA, the next one, is a government insured loan. Again, this allows for maybe people with not so great credit or less than stellar credit to be able to qualify. And also this is the one that has a 3.5% down payment, FHA. Next one, VA. This one is outstanding for our service members and veterans. You can actually do 0% down on VA. A lot, like I said, a lot of my clients are veterans and VA, and many times we can cover, so they have 0 down payment, and we can cover a good chunk of the closing costs as well. So I've had veteran borrowers who make the transition from renting into buying and end up paying less because you skip a month when you buy a property. So when you first begin paying your mortgage, so in that transition, they actually saved more money than they were renting. That's an outstanding loan. Ton of benefit to it. If there's any veterans on this call, absolutely reach out to me directly because you guys have the easiest path towards home ownership. And then self-employed, go ahead.
Can you repeat that again about skipping a month's payment? So if you bought a house and you close, it's May 4th right now. So if we close anytime in May, can you go over that?
Yeah, correct. So if we, for example, a couple closings we had today, if you close within the month of May, you would think that your first payment would be June 1st, right? Where people were accustomed to renting, you pay every month. But when you are purchasing a home, you actually skip your first month's payment. So people that close today, they don't have a June payment, and their first mortgage payment isn't until July 1st. And they have a window from July 1st to July 15th, actually. That's the grace period. So sometimes even when you're buying a place, it gives you a little bit of a reprieve from your rent because that's skip month.
Yep. Thank you.
Yep. And lastly, self-employed, if there's any business owners out there, you have a little bit of a different path. Sometimes it can be a bit of an obstacle just with the way that tax returns are filed as well. I do a lot of self-employed and business owners. So definitely just reach out to me directly and we'll go over your scenario if you're interested. Okay. Oops, I clicked off. Okay, this just goes into a little more detail about what I mentioned earlier about Home Possible and Home Ready. A 680 FICO is required, allows for 3% down payment. Rates are outstanding on this program too. You're looking at, if we're basing it on rates today, probably around 3.75 on a 30-year fix. So even though it's only a 3% down payment loan, the interest rates are outstanding on it. They make it really easy. Okay, here's a scenario for you. This is a common one too. People just want to know roughly what their payment would be, right? I'm sure Verner will talk about this as well, but that's one of the bigger components is the affordability, and are you going to be comfortable with making the transition from renting into home ownership? Payment is important. So here's a basic scenario of somebody who the purchase price would be at $500,000, a 3% down payment, so roughly about $15,000, and the monthly principal and interest payment for that would be $2,246. So those of you, this gives you a general idea. Those of you who are starting to look at homes online or with Verner, I don't know if any of you are in that process already, but roughly an idea based on today's rates of what your total payment would be. The monthly payment, taxes, and insurance section there that you see, that's important because when you buy a home, your taxes and insurance have to be accounted for as well. Most of the time you'll pay them included in your payment. So I recommend that for first-time homeowners for the most part. Here you see when you add in taxes and insurance, just a rough estimate of what to expect and that total monthly payment to come out to on this purchase price.
Yeah, and I think this part is really important. Of course, like David mentioned, people want to know, hey, I'm paying this much in my rent right now. I'm comfortable with this payment, or I can stretch a little bit more to here if it's the right house. And I always tell my buyers, hey, the few things that are going to be the most important when you're purchasing a house is, one, your payment, because not only do you live in the house, but you live in the payment. That's the payment you're going to be making every month. And then, the location and things like that. But since we're talking about payment, interest rates are at a ridiculously low rate right now. 3.75, which David, you can probably attest to, is kind of more of the, I don't know if it's the norm or that's kind of where the average rate for a top tier credit is. Okay.
I would say that's the average running for the past maybe several months.
Okay, perfect. So just to give you an idea, when I bought my home just a year and a half ago, I was stoked and really happy to get, I think it was a 5.5%. Right. I was really excited. In that time, that was really low. And historically, anything under, I think, 7% is actually pretty low. So seeing rates at 3.75 or even like under 4 is crazy. So David, if you can just take a second just for people to kind of realize that what would a payment be at the same scenario, $500,000 purchase price, 15% down, 3% down, so $15,000 down. Your payment is $2,846 with taxes and insurance at 3.75. What if it was a year ago, or what if next year rates jump and the rates are 4.75? So just like a 1% bump up in rates. So what would that be?
Let me calculate that for you. I can't access it because I'm on full screen right now. So I'm just doing it on my phone really quickly. So bear with me.
Give me a rough estimate.
Yep. So at 500,000, instead if we bumped it up to, let's say 4.5 or 4.25.
Just like one full percentage rate, if you can do that.
Okay. So.
And like I said,
4.75. Yeah. You'd be looking at a principal and interest payment of $2,608.
So your principal and interest would go from $2,246 to $2,608.
2,608. Yeah.
2,608, and that's not including taxes and insurance. So maybe just another couple $100. So you're looking at
a 300 plus, like $370 increase in your mortgage payment. Yeah. Just with that increase in rate to where.
Yeah. So a 1% increase in rate, you're looking at, instead of 2,846, you're looking at maybe 3,100 or so.
Yeah, right. It's big. So if there are people out there that are starting to really strongly consider it, now is a good time, just because even just look it up on your own too. Just go to Google and see what interest rates are historically. You'll see a pretty interesting chart there, a graph showing you where we are now and why it's a good time if you're in this market.
Okay, cool. Thank you. I'll let you go.
Yep. Okay. And then FHA, again, this is the government insured loan. Make it a little bit easier. It was originally intended just to make homeownership more accessible to people with maybe less than stellar credit, maybe lower income. It allows as low as 580 FICO. That's changed a little bit now in this climate, but historically we'll probably go back to this level. It's important to think of 580 as a good metric. So even if somebody has, let's say, like a 550 FICO right now, we can pretty easily get you into a position, if you have some open accounts, up to a 580 with a little bit of planning. So it's 3.5% down payment, pretty forgiving, even if there are some collections on there. You do have mortgage insurance, both upfront and monthly, and very clearly stating it there, that is a disadvantage. So anytime that you have, honestly, it's a riskier borrower the way you're looking at it from a lending perspective. So it comes a little bit more of a premium in terms of mortgage insurance. So that's an additional fee that you pay to the bank for giving you the loan, to put it simply. But FHA does come with that. Okay, again, just reiterating, VA, it actually has the lowest rates and the most lenient guidelines. This is a way of thanking service members and active and veterans. We can do 0% down payment and easy programs. This one is the exception that I mentioned earlier. Just we can use bank statements if you are self-employed and you've had either an LLC or a corporation or a sole proprietorship for a minimum of 2 years. So if anybody out there is in that scenario, definitely give me a call so we can figure out some options for you. We can do as low as 5% down. Fantastic alternative traditional financing. It's a loophole that we can use. It's only coming to the market in the past few years, but it's fantastic for business owners. It's been a big product for us and getting self-employed people homes. Okay, just some quick credit basics. Most of you probably know this stuff, but important to know in case people aren't that familiar with their credit score or this section. But late payments, the main thing that affects your credit score, late payments. That's the worst thing that you can do in terms of negatively affecting your credit score. Keep balances at a minimum. So if you have let's say a credit card that has a $10,000 credit limit, you want to keep that definitely below 20% usage, but ideally below 10%. So if you have a credit card that allows for $10,000 in credit limit, you want to keep your balance, if you carry a balance at all. It's better not to carry one rolling in, right, for interest purposes. But if you do carry a balance, try to keep it below 10 to 20% of what that limit is. Do not close older accounts in good standing. This is a very common mistake that I have with first-time homeowners or people that aren't that familiar with credit. They think that when they pay something off, and this is kind of weird because it's counterintuitive, and I agree for the most part, but it's just not the way that calculations are done. If you pay something off, like a credit card, closing it, if it's one of your older accounts, actually hurts your credit, okay? I'll answer any questions specifically about this or on one-on-ones if anyone's interested, but do not close older accounts. Let's say you have a Wells Fargo credit card from when you were in college or something, and you have a 15-year history on it with no late payments, and you pay it off and you get excited, so you say, I'm paying it off and I'm closing it. It's actually a big mistake. So
you're actually just wiping out all that positive history.
Yeah, all that credit history. So that's a huge one. Another reason why it's important to go over this stuff early, if you're even just thinking about going into a home, I can very easily assess your credit report. I have even a history before mortgages in the credit world as well. So we can definitely discuss that in detail. We need to typically address collection accounts. So sometimes people don't even know they have this. A medical account from an urgent care visit, or a cable bill from when you moved out of your last place and then you didn't pay the last bill, or they tacked on some kind of fee and it rolled over. Same thing with utilities. Sometimes those things pop up on your credit and they cause havoc. So it's important to identify those things if they're there. And most importantly, use credit responsibly. If that's something that every lender is going to look at, it gets you better terms and everything, really. If you're going to go get an auto loan, gets you better credit cards, gets you better homes. It all connects. So that's it on credit. If you have any specific questions, I handle a lot of those questions. So give me a call anytime if you need to go over your scenario with that. Last one here, I think on my end, but the importance of the pre-approval process. It's hugely important, especially before you go out with Verner or anybody else in looking for a home. You want to identify all these things ahead of time. The absolutely worst thing that you can do is have surprises come up. Let's say your dream home comes up, it's within your price range, and then we wait and we pull credit until then. Some surprises that you may not even be aware of. And as Verner will attest to here shortly as well, once you're in escrow, the clock is on. We have a certain number of days to perform So you don't want to be doing credit repair during that stage. You're going to have a lot of other concerns, and it's going to be little hiccups along the way. Yeah, that all this can be addressed beforehand, and frankly should be addressed beforehand, just to make it easier on yourself. And then also, you're only shopping for homes within your price range. If you're online late at night, clicking through things, you want to make sure that you're only scheduling appointments or kind of tailoring your range to what you can actually purchase. That just makes sense. Conducting a focus search. When you make a serious offer, when you're ready to make an offer, one of the things that I supply to Verner's clients is called a pre-approval letter. What that means in the home buying world is that somebody like myself, who will in essence be your lender and lending the money for the mortgage, has reviewed all of the above, all we mentioned before, reviewed tax returns, reviewed your credit, your score, your accounts, made sure that you have the funds needed to close, all of that. And then we issue the pre-approval letter to yourself, to the home buyer, and to Verner, so that when he is ready to make an offer on your behalf, that is included in your package. Makes it, again, Verner will talk about this, but you basically need it in this competitive environment to have your offer taken seriously. The likelihood of someone accepting your offer without a pre-approval, it's pretty slim. Again, what I talked about ensures a smooth escrow. You want, escrow is the time limit. I won't go into Verner's presentation here, but it's the time limit that you have when you go from having an accepted offer to closing. Those typically 30 days or so. But it ensures a smooth as possible process throughout that time. If we get all this stuff out of the way. And ultimately, the last thing, just ensures you get the house or the home that you want, which is what all this is about anyway. So hugely important.
That is correct.
Yeah.
So everyone wake up. All right.
Yeah,
so now
implies I put him asleep. Come on.
Yeah. All right. So now you understand the importance of credit, what loans are available to you, how much you might need for down payment. You sent your info to David. He's been able to look over it, and he gives you what the coveted thing, a pre-approval letter. And like he said, it's going to narrow down your search most importantly. So you're not looking, if you're approved for $500,000, you're not going to go into Del Mar trying to find a 5-bedroom home. You know, you're not going to be able to afford that. So it really narrows down your search to get you really focused. And ultimately, more importantly, in today's environment with COVID-19, sometimes that's required even before they even will let you look at a house. So they want to make sure that you're an actual buyer. You're not just some looky-loo going to come in and touching all their things. And yeah, it's really important to get a pre-approval letter first. So now that you got that, congrats, you are ready to house hunt. Like I mentioned before, there's just a few differences that are happening now with COVID-19. The main difference is there's just an extra layer of safety and health and hygiene that is being put at the forefront before you actually are able to search. So most people will look on Zillow or Redfin or like an app, or I'll send them, you know, homes that I think they might be interested in. And you look online, that's fine. You do virtual tours, that's perfect. If you want to go see a home in person, the biggest thing is that you're going to have to do what is called a property entry advisory and declaration form before you're even allowed to go see a home these days. Some agents are a little bit more lax about it, but let's just, for sakes of this conversation, it's going to be a necessity. What that basically states is that you don't have any symptoms currently, that you are aware of the inherent risks of being in someone else's home, that even if you are in their home, you will not touch anything. You won't just sneeze all over their furniture. And you're aware of what's going on, basically. So you have to fill it out for every home that you go see before you even go see it. Another thing that they're asking now is that you wear masks, and either take your shoes off or wear booties, you know, the little foot coverings. The seller will typically not be home. Again, there's no touching of anything that's not necessary. You can open up the door, obviously. You can look in, you know, the bedrooms. But they don't want you turning on the lights and touching everything, and just they'd rather have you touch less, basically. And like I said before, sometimes a pre-approval letter will be required before you can even go look at a home. So again, the importance is pre-approval first. So talking about seeing homes and going out there, you're looking online. I'm sending you homes via email. There's not really the days anymore right now, at least, of open houses. It's all kind of one-on-one appointments. But say you do find the home of your dreams and you're ready to make an offer. So I wanted to talk a little bit about expectations, I guess. Currently, right now, the real estate market is still pretty strong. Just because COVID-19 is happening and the stock market is in flux pretty much daily does not necessarily translate to the housing market plummeting like it did in 2008 and 9 right now. So if you have an expectation of a $500,000 home, don't expect to get it for dirt cheap at like $400,000. House prices are still maintaining a strong value. And then when you're ready to make an offer, how do you know what the best price is? So that's my job to do some research. I'm basically going to be looking at comps, and what a comp is a comparable sale in the area, to look at what prices houses around that area have been going for, so you can make a competitive and fair offer. Of course, my job is to try to make it as good for you as possible, but I just want to set that expectation. When you're also writing up the offer, not only is it just about the price, but we're talking about terms as well. How long is the escrow going to be? When will the escrow end? When will we be doing the home inspection? How much is your loan? All those things are predetermined and put into the contract so that the seller of the property knows exactly who you are and what you plan to do in order to buy their house. Now, once you make that offer, the seller has an opportunity to not just accept it, which is a possibility, hopefully they do, but they can counter any one of those terms. They can counter on price, they can counter on length of escrow, they can counter on pretty much anything that they feel is necessary to make it fair for them. So I want to make sure you guys are aware of that. And then if you'd like, you can always counter back and forth until both parties are in agreement and those documents are all signed and everyone is agreeing in contract. Okay. So again, contingencies. I put this lovely couple on here because in my thought, contingencies are a lot like dating and steps that you reach and milestones you reach while you're dating. So if you will, imagine that you meet a guy at a bar and you want to get his number. So all your criteria is thinking about when you're at a bar, he's tall, dark, and handsome. That's it. That's all you kind of know. When you go to a house, all you really see is, it's on a corner lot and it's got 3 bedrooms and 2 baths and it's painted white. You don't know a lot about that property. You're just looking a little bit on the surface. So contingencies are there for you to explore that house a little bit more in depth. Take it on a second date, if you will. Get to know its parents. The seller's disclosures are basically the owner of the property telling you what's wrong with the property. The physical inspection is your ability to go inspect that property from head to toe. Roof, foundation, electrical, plumbing, heating and air, appliances, everything. And then the loan and the appraisal are just like a third party, making sure that that value is there in terms of the appraisal, and David or someone like David to make sure that that loan will continue to go through. So if you can, kind of think of it as dating, you're going through these steps until you get to ultimately maybe marriage. Okay, so here's the escrow timeline. Like David said, it's approximately 30 days. That varies depending upon the situation. And the seller situation and your situation. So, but ultimately, let's just use 30 days as an example. So as soon as you make an offer and the seller accepts it, let's say, that's when escrow begins. And escrow is a third party that basically is going to look at that contract and make sure both sides are upholding to their agreements. Okay. So that day is when escrow starts, and that's when all contingencies are based off of. Okay. Typically within the first 3 days, you're going to want an earnest money deposit. And that's usually between 1% and 3% of the home's value. So back to that back to that example of a $500,000 home, typically that's going to be between $5,000 and $15,000. Usually it's around 2%. So let's just say $10,000 that you're going to put into escrow to basically let the seller know that you're legit. And if anything goes wrong, you have a little bit of skin in the game. Okay. And now, David, can you also explain, or at least just confirm that earnest money? So say I only have $15,000 to put towards a home. That earnest money is also part of that down payment. That goes towards the down payment as well, correct?
Correct. Yeah. Whatever funds you decide to put, or you negotiate really to put into escrow into that third-party account initially, those funds will be applied towards the down payment and or closing costs. So you just set them aside a little bit early.
Yeah. So the down payment and this earnest money aren't two separate things, really. It's all kind of your lump sum that's going towards the house. And that's, like I said, that's usually due within a few days of opening escrow, just to let the seller know, like, yeah, I'm legit. I'm going forward with this. So like I said, the seller's disclosures, that's when the seller's going to fill out this whole form that says everything that they know to be true about the home, whether it's a defect, a problem, a previous leak that was patched, anything that someone died in the property, they're going to let you know everything that they know to be true. So this is, like I said, kind of like your dating. You know, you're kind of getting some information about the property. You're kind of getting some data. That's usually due within the first 3 to 7 days. That all can be negotiated, but usually let's just say 3 to 7 days. And before you get that, or excuse me, once you get that, we'll do our home inspection. Okay. So I like to have the seller's disclosures first. That way I know I can tell the home inspector what to focus in on. If the seller's disclosures say, hey, yeah, there was a leak in the roof, 2 years ago, but we got it fixed. Then I go with the home inspector and I say, hey, check everything, but also they told us that there was a leak in the roof. Can you double check that? So we'll do the home inspection, and that's a physical inspection of the property. Like I said, they check the roof, the foundation, electrical, plumbing, heating, air, appliances, everything in between to make sure that everything is properly working and safe. Okay. Then about 21 days, typically, is when your appraisal and loan contingency will be due. That's when David will basically take all that information that he already has for your loan, give it through underwriting. They'll basically sign off. David, you can probably jump in here a little bit more about what that approval means. You there?
I'm sorry, I was reading the questions. What was that part?
I was saying you can kind of tell them a little bit more about what the loan approval means.
Yeah, so loan approval, what Verner's alluding to there with the 21 days is we want to, whenever we submit, so we gather all your documents, you get some initial disclosures, and then the big chunk of that is the underwriting portion. So underwriting just means that somebody reviews all of your documentation and then issues you an approval or denial. Typically, it'll be in the form of a conditional approval, which means that there's a couple more items that need to be cleared up so until you get the loan itself. But when you're in escrow, you get a period of, sometimes it's 14, 17, 21 days to basically have all your ducks in a row. Another reason, what I was mentioning earlier, why you want to make sure that everything is addressed beforehand, that there are no surprises at the beginning of escrow. This is what I meant, that you're on the clock. If you have delays with having to repair something on the credit or get a bunch of additional income documentation that's required, you're eating up this 21-day period, which is going to be stressful for everybody involved because we have to perform within this allotted time. Yeah.
And just so I want to make sure it's clear too, just like dating, if you hear something that you don't like in a date, date 5, they say they worship Satan, or, you meet their parents and it's just not going to work. All these contingencies, the seller's disclosures, the home inspection, one thing that's not on here is HOA too. Like you'll get HOA documents. If you have 5 dogs and HOA only allows you 2, these are all moments in time that you can back out of the deal and still return your earnest money deposit without any penalty. These are all moments where you put your money in, you say, I'm going to buy this house contingent upon everything checking out. Okay. One thing too about the home inspection, when you do your home inspection and you get the seller's disclosures, you're going to find anything wrong about the property, right? So if there was a leak, if your home inspector did find the water pressure in the home was off, if they found whatever, that's your opportunity to go back to the negotiating table and say, okay, Mr. Seller, Mrs. Seller, we found X, Y, and Z wrong with the property. These things are actually safety hazards or they're not. Can you either fix them or give us money to fix them? They don't have to do either, but that's definitely an option to go back to the table. If they choose to fix them, if we negotiate the fix, if we negotiate either the credit to fix them, then you can check off that home inspection and the physical inspection and contingency, and we'll continue to move forward. So it's kind of like, you know, someone saying, hey, I don't want kids when you're dating them. And then you say, I want 2 kids. And they say, okay, we can have 1. So you can, and then you can move forward. Maybe it's your option to move forward or not. I don't know. But then the next thing comes is the final walkthrough. And that's within the last 5 days or so before you're set to close. In this 30-day approximate escrow within the last 5 days, you and I are going to walk through the property again, just to make sure that the seller did fix anything, that those fixes have been made. If a water pipe burst in the last day or two without anyone knowing, we're going to want to know that. I jokingly say we're going to go check the property to make sure a tree hasn't fallen through it in the last days. It's just to make sure that the property maintains the same quality that you last saw it in, okay? And then once that is complete, if that is all good, we are going to get your keys. Congratulations. You are done with your escrow. Yay. And you are now an official homeowner. So with that being said, I think that's pretty much it. We're going to go to questions. And if you have any questions, please let us know.
They're in the chat section, Verner. Do you see it?
What?
They're in the chat section, not the Q&A.
Ah.
Yeah, there's a bunch of good ones.
Chatty chat. Okay, so let's see. I'm going to go through some of these questions. Hopefully the people who asked them are still on. I was looking at Q&A over here. You don't need your cameras on, so if you've been trying for an hour, 1 to 3 months, buying soon, hopefully. Okay. So David, I don't know if you saw this as a 95% loan, 1 loan, or a split 80-15.
I'll answer that one. So Ro, good to see you on here. You can actually do it both ways. Now, a lot of the terms on home financing before, maybe 10 years ago, we saw a lot of 80-15 splits. This question is about 80% of the home's value would go on 1 loan, and 15% would go on a 2nd loan, and then the 5% was the down payment, right? So now you can actually do 1 loan at 95%, all rolled in. So good question.
Fantastic. Another loan question looks like, will it be harder to get a house if I do not have a job in the same field for 2 years?
It will be more difficult. That's a case-by-case basis again. Definitely, Alice, talk to me. We'll figure out what those changes have been, what caused them. We have to take into account the gap between both jobs. If they're somewhat related, if it's entirely different, we can talk about that. It does make it a little bit more challenging, but it doesn't mean that it's impossible. Definitely something worth visiting.
Do the loan requirements change if one of the persons is self-employed, but the rest are not self-employed? So this is like a maybe a family buying it or a husband-wife.
Yep, that's a great question. I mean, that's most self-employed if they have a spouse. That person is not also aligned with the business or maybe has their own separate job of their own. So no, the requirements are the same. The calculation for the self-employment income is done one way. And then let's say if the other person is an hourly worker or a salaried employee, then we just combine those. The calculations are different, but from your side of things, it doesn't matter at all. That's, in fact, most loans are that way.
Yeah, I'm going to ask this question just because I like the way it's written. How long should your cash money be in your bank before you decide to get a house?
I like that one too.
Yeah.
At least 2 months, but I would prefer it's in there longer. So when you're going through the process, if there's any, even if there are deposits that are large, let's say you got an inheritance while we're in escrow, or the couple of months right before you're going into escrow, when we take a look at those bank statements, underwriters are trained to look for any kind of discrepancies in your financials. So if there's large deposits, is a very common one. Let's say you normally make $5,000 a month, but somehow there's a deposit in there on 1 month for $55,000. You're going to get asked a question about it. So the sooner you deposit that cash into your account, the better.
This one kind of goes back with your maybe self-employed question. My husband has his own trucking business and I don't work. Does it make more sense to apply for a home loan in only his name?
Good question. Not necessarily. We would have to look. So most of you, I believe, are in California, right, Verner? Most of them.
Mostly California, yes.
Okay. So in California, we're a community property state. What that means is if you're married, we don't have to include you on the loan, but we do have to take a look at your debts as well. So if you have separate debts on your credit that are not on your husband's, for example, with the trucking business, we still have to take those into account. I'm going to throw in the term from before into your debt to income ratio. So we can assess that. Sometimes it's best to leave the spouse off of the loan and then just put the spouse on title. Not to get too far into the weeds, but those are two separate things. So we have the loan, which is the financial instrument, which is the money that's owed. And then you have title, which is the document that gets recorded with the county. Both of them are part of home ownership, but you could be on one and not the other. So that's a very common part of a transaction too. But again, Samrit, I can answer that question if you give me a call or see what makes more sense for you guys in particular.
How does earnest money work with a VA loan?
Great question. So again, VA borrowers have the best situation. Hopefully there's at least one of you on there or the person who asked. I have actually had many borrowers, even just this past month. VA sometimes will get a good chunk of that money back, right? Because if you recall, there's 0% down payment. We can cover a good chunk of your closing costs. So if there's no down payment and little to no closing costs, and let's say your earnest money deposit was only $2,000 that you set aside, just so you're serious, I've had borrowers get money back. As crazy as that sounds, that will not be the case for most people, but it still gets applied, it gets accounted for, and if we don't need it to close, you get the money back.
Yeah, I can attest to that. David definitely helped me with a VA client, a couple VA clients of mine, and I don't want to say they got paid to buy a house, but they put no money down. David covered the closing costs, and they got money back. So they purchased the house, then got money. Can you revisit the terms if you find out anything at this time? So I guess maybe like revisit the terms of the loan, or revisit the terms of the contract.
The contract they're asking, right?
Okay. So I'll answer this as a realtor. You can revisit the terms, but the terms were agreed upon initially. So you can revisit it, but it's basically a renegotiation, and it has to have like some reason why. Let's say, well, COVID-19 is a great example of, things happened and you're supposed to get something done at this timeline, but circumstances change. As long as there's communication, most realtors and most people are okay with changing some things, or at least having some leeway. But ultimately, it's a written contract, and the terms are what the terms are when you open up escrow. So it really has to depend on the situation and the seller and the buyer's ability to be lenient. How long before you should stop using your credit cards?
You don't want to be using your cards. I mean, you could use them for small purchases, but you don't want to alter the balances or that's a great question, actually. So one of the things that I'll go over with you, if you do go into escrow, you don't want to go finance a new car. You don't want to significantly increase your credit limits or close accounts, or let's say, again, use a $10,000 balance on a card. Run up the balance to $9,000 while we're in escrow. Those are big no-nos. You don't have to stop using them entirely, but definitely no large purchases of any sort when you're in escrow, even beforehand.
Yeah. Is now a good time to buy? My thoughts on this are, interest rates are insanely low. And like I mentioned before at the beginning of the webinar, you live in the layout of the home, you live in the location, and you live in the monthly payment. So based on the interest rate, I think it's a great time to buy because that's the payment you're going to be having for the remaining portion of the time that you live in the home. Our house is going to go up in value, down in value. I never say I have a crystal ball. I'm never going to say like this is going to happen. I think, and I'm not sure, David, if you know, but I think 2008 is one of the only recessions that housing prices went down tremendously. And that was because of lending guidelines and the real estate industry itself. So this is something that's not real estate specific. It does have a lot of implications in terms of employment and things of that nature, which we'll see in maybe 6 months to a year. But as of right now, all I can speak of is what I know right now. Interest rates are super low. House prices are still holding strong. So I guess in short, yes. Did you mention something about having the 15% in the bank in your account versus having cash?
I'm trying to scroll that. Where are we here?
It was.
Oh yeah, there it is, from Rob, right?
Yep.
Okay. Yes, you want to make sure. So one big portion of buying a home is you have to have the funds sourced and verified. So we have to know. So when you look at your bank statement, right, you'll show you your beginning balance and then your ending balance. Most of us don't really look at our bank statements that much anymore. A lot of people will send me like the account activity, but on your actual bank statement that gets sent out once a month, probably just email to you. You just save it in a PDF, whatever. But you'll see the beginning balance and the average balance and the ending balance, right? So you want to make sure that that beginning balance is pretty consistent. So short answer to your question, yes, it needs to be in the bank.
All right. What is an HOA? Are the home inspectors hired by the buyer or the seller of the house? Would you rather, where would you gather information about if a house is in a flood zone? Really good questions. An HOA is a homeowners association. It's basically an association that makes sure that the house's values stay up. So I pay, for example, $100 into my association, and they make sure like the house across the street, if they stop cutting their grass and they have a broken down car in the driveway, they're going to get a notification that, hey, we need to make sure that your property value stays up. Make sure that your front of the home looks okay. Also in condos and townhomes, HOAs make sure that, again, property values stay up. They might cover roof insurance and the exterior of the home. So if the roof leaks and you're in a condo, the HOA would actually take care of that. So that's an HOA. And when you buy a home, technically per contract, the seller doesn't have, the house is sold as is. They don't have to do anything. They don't provide you with, the home inspector. They don't provide you with anything. So it's your responsibility to hire the home inspector. If the home inspector finds there's a leak or a plumbing issue, you can then follow up and hire a plumber. You can hire anyone you want to basically come in the home and inspect anything that you want. So it's on you, as the buyer. You would get the flood zone information from a natural hazard disclosure that gets ordered from the seller. That's one thing they do provide. The seller will provide that. They'll order it through escrow. Escrow will give it to you, and it's just a long document that says you're in an earthquake zone, a flood zone, fire zone, which could affect your insurance, but that's a little bit more, depth of question. So that's that. How can we go about talking with our realtor about a realtor credit towards closing costs? Also, can it only be from the realtor or both the realtor and broker as well? You can just ask the realtor, hey, can you cover some of my costs? Some realtors do, some realtors don't. And yeah, it's basically up to them. Also, can it only be from the realtor or the broker? So the realtor is in charge of their own commissions and their own business, essentially. So it's going to come from the realtor. How much does FHA loan affect rate?
Okay, I think what the question is asking is the premium, or once you add in the monthly mortgage insurance, what the payment comes to. It will increase the monthly payment once you add in the mortgage insurance. me reread this though. How much does the FHA loan affect the rate? FHA rates, okay, so maybe this is what it's being asked. FHA rates are actually pretty low. FHA and VA tend to be the lowest rates, but once you add in the mortgage insurance, the monthly cost that it's going to cost you to have an FHA loan every month, once you factor that mortgage insurance in, it ends up being higher than conventional. So I think of it as a tier system. The best loans I would say is VA. Second, I would go with conventional. And then thirdly, FHA in terms of what's going to save you the most money. Yeah.
And then again, that mortgage insurance, that bump in rate, that gets removed, or how does that work when you go from, say your loan is at 95% of the home value, and then when it hits past that tier of 80%, how does that work?
That's a great question. It used to be that way, but now FHA insurance stays on there the life of the loan. You have to refinance, which is very, very common. You have to refinance to get out of it. Before, if you could submit proof now that your home was worth, or that your loan was now less than 80% of your home's value, the mortgage insurance, you could basically petition to have it removed. FHA changed those rules a few years ago, so now you actually have to refinance, which it really isn't a bad thing, especially in this environment where rates are low. To get out of your mortgage insurance, it makes sense. I mean, again, Verner can talk about this, but most people, nobody stays in their mortgage for 30 years. Most of my clients that have been clients for many, many years have refinanced multiple times. Different events come up. So refinancing is not a big deal once you are a homeowner.
Okay. Here, I'm just going to switch around a little bit. I have money saved under a family member's account. Would it be better to just keep it in my bank from this point if I'm going to buy in the next 7 months?
Sorry about that.
No.
I didn't actually sound.
They have money in their family member's account. Would it be better to just keep the money in their bank if they're looking to buy in the next 7 months?
If they are so if the family member is going to gift you the funds, then it's fine for it to stay there. It's kind of touchy to answer this question because technically they're not your funds. So
right.
We can either only use your funds or we have to document them as gift funds. So we want to very clearly define ahead of time how it's going to be structured so we document it. It can be done. We just need to go about it the right way.
Okay, what happens when you are newly divorced in regards to previous taxes that would show his income as well?
That's fine. We separate it out. That's a common one. So we will not be using, once the divorce is finalized, separated is different. So if you're separated, it does have to account for it together. If you have a divorce decree and the divorce has been finalized, then we will not be using the spouses. We will only section off your income and only use that for qualifying purposes. Good question though.
Would a car payment be considered if it is not on my credit? It's a private dealership.
If it is not on your credit, most likely no. However, if it's on your bank statement, it could. Probably not the answer, not the most clear answer, but I feel like that's the best answer. It could come up. So we'd want to know it beforehand if you do make that payment monthly. Because let's say you have to supply, most people have to supply at least 2 months bank statements. And if an underwriter is viewing that, you'd want to disclose that and then prepare accordingly.
Okay. For a new development, if the property isn't ready until 5 months from now, how does the closing process work in terms of the timeline? And will they be paying the loan even before they move in?
No, you only start paying. So the escrow doesn't close. Escrow is different. What Verner had mentioned about that timeline, it's very different for a new development. So you time it differently, but no, you will not be paying if you're not living there, and the loan won't close until everything is basically complete. That's one of the things that we ask for, actually.
Yeah, and that timeline is basically, in my 30 days, it's just pushed way out, in this case, 5 months. Yeah. So you'll kind of enter escrow, but not a lot happens until kind of the end. When the house is built and then the loan is ready, it kind of all gets pushed back here. Another comment I want to make too, in terms of new developments, make sure if you do want to use a realtor, or if you do want to use me as your realtor, make sure that I or your realtor visit the property in the new construction sales office with you on the first visit. So if you go into the sales office and you sign up, you put your name down, from that point forward, I can no longer really help you. So I just want to put that out there that I need to go with you, register you if you do want me to help you out. And yeah, just want to make sure that that's known, I guess. Is it possible to get a loan to renovate if you buy with a VA loan?
Is it possible? Yes. There's some different guidelines that have been placed recently on that. But yes, it's called a VA renovation loan. It is a little bit, you have to jump through some more hoops for it, and you have to work with a contractor. You have to submit your bids early beforehand, and then we base the purchase on the future assessed value. So it's a pretty cool tool, but it does involve having bids beforehand, knowing what work you're going to do specifically, and then having that be part of the underwriting process. But the short answer, yes.
Okay, good. Can I get a grant for the down payment and also give some of my money for more down payment? So can they use a grant and some of their money?
Yes, you can definitely do that. That's a common use. If you do get, like, some cities have grant programs, counties, and yeah, you can absolutely get a grant and then use the rest. We just have to document it again. It's not like a broken record, but we have to source and verify. It's a really good thing to know for a first-time home buyer, because a lot of times, let me go off on a little bit of a tangent, but the other purchase that a lot of people identify with is like when you buy a car, right? Especially for a first-time home buyer, this is not like that. It's a completely different process, and source and verify is the name of the game. So
yeah, I just finished a purchase with a first-time home buyer, and a lot of these questions came up, and David said it best, and I just reiterated it to them. Think about it this way. For example, your $500,000 purchase, you're putting 5% down or 3% down. So that means the bank is giving you $485,000 to buy the house. They want to make sure that everything, all T's are crossed and all I's are dotted, and they want to know what's going on with you and your ability to continue to pay on that loan in case something were to happen. So they're just in a business of risk, giving out like $400,000, and they just want to make sure that everything is good.
Yep.
All right. So can you be a realtor? Can I be a realtor if I live in another city, like Santa Barbara? So my main focus is San Diego County. I've done purchases and escrows and bought homes as close to the border as you can get, and as far up as like Temecula and Riverside. I can definitely help you. What might also work is if you contact me, tell me a little bit about what you're looking for, your budget, maybe get pre-qualified from David would be the best thing. And then I can connect you with another realtor that I trust and know in that area. So I have a network that I can reach out in other cities and areas. If you're in another state, even, or, in LA or whatever, I can definitely help you out. So definitely get in touch with me. And we can kind of help you out regardless. I want to make sure that everyone knows too that David and I work together in San Diego a ton, but like David mentioned, he is licensed through all of California, and everything that he does is basically electronic. So if you live in San Francisco, Sacramento, you said Washington as well?
Washington as well, yes.
Washington as well. He can be your lender, and you can just email him and you can kind of work with him. I, on the other hand, like I said, I mainly focus in San Diego, and while I do travel a little north and go a little bit south, I can definitely connect you, at least at minimum, with someone that's in your area that has my same work ethic and values and ethics. So just want to make sure everyone knows that. Let me just make sure. You work with people out of state moving to California? Absolutely. If you are moving to California, definitely reach out to us. We'll definitely help you out.
Common one.
What's that?
Well, just answering the question as well. That's a very common situation.
Yeah. And then I have a slide at the end where do we get our info? Let me slide, I guess, to the next slide so you guys can see our info while we answer any more questions. That is my email and my direct telephone number. That is David's. Is that your cell phone or is that your business line?
That one is cell phone, but feel free to call it. That is,
Yeah.
for all intents and purposes, the business line.
Yeah. What else here? New development.
A bunch of good ones. I like the engagement, guys. Thanks for all the good
Thank
questions.
you. Thank you so much for your questions.
Yeah.
How does credit usage affect rate and approval?
Good question. So credit usage, again, you want to keep your credit, the overall usage or utilization you'll see if you have like a CreditWise account or something, those of you who monitor your credit. If you keep it beneath 10%, that's best because that will affect the algorithm basically for your credit score. So credit usage significantly affects your rate and approval. The better your credit score, typically you can get a better rate. To put it, to oversimplify, but that's kind of how it works.
Okay.
So yes, your credit usage will affect your rate.
Last couple here. If someone's unemployed for a seasonal job, it gets unemployment. How will that affect buying a house?
If it's a regular part of, obviously we can use the unemployment income for qualifying purposes. One of the things that we look at is the reliability and stability of that income, and unemployment doesn't qualify for a mortgage, but it doesn't mean you're affected. So like, let's say if you're a farm worker and you are laid off technically for certain seasons, we would be able to use the income that you generate during your working time, but we can't unfortunately use unemployment or like short-term disability, things like that aren't long-term from work.
Yeah. What are the pros and cons of adding your kids to a house title? Will that hurt them in the future with financial aid or college when they decide to buy their own home?
It depends. I mean, I hate to answer questions like this with it depends, but it can help them with their credit score. If you put them on the loan, you can help build their credit history unless you default, right? Maybe if you make a late payment, now you've hurt their credit history. Putting them on title, it won't affect their chances of home ownership down the road. To me, a better solution for that is talking to, I don't know if Verner, you agree with me, but talking to a trust attorney to have those conditions in place. That's typically why people want to add their kids to title, at least from my experience, what I see. So that would be a better route. If you want to help them with the credit score, then yeah, you can add them to the loan. To answer the second part of that, for qualifying for their own home, you would just have to then supply proof that you are the person making the payments and not them. Typically that's done over a 12-month period. So you would then be forced to supply 12 months bank statements to prove that parent is paying the mortgage and not child who now wants to go buy their own property.
Where do you think the interest rates will be staying low for the next 6 months? People don't use grants for the down payment. Is there a reason why? You want to answer?
Okay, two different ones. Rates, I mean, we don't know, but
yeah,
you get different ideas, and ultimately, we don't know. Also,
yeah, there's no crystal ball.
Yeah, if we knew, I mean, yeah, it'd be a different game. But we foresee for them to stay low relatively for the rest of the year. But if they're going to be at the same level exactly, we can't really know. They actually change daily. So for people to understand that, what we do when you are applying, you lock in a rate, and it gives you a lock of typically 30 days or at minimum the escrow time, and you are guaranteed that rate for that time. But interest rates in the world in general, they switch daily, and in this environment, sometimes they switch multiple times a day. So that's the case. Yeah.
Any more question, guys? That was amazing. Thank you for asking all those. Thanks, David, for giving your honest opinion. Oh, I have one more that's coming in. Right. While that's being typed, I really want to thank everyone so much for being here, for taking the time. I know 6 p.m. is in the evening. It's hard for a lot of people. I know maybe you're done with work, but for those that have kids or, you know, spouses or whatever, and things are going on, I really appreciate it. And does a VA loan have monthly insurance like FHA loans? We'll end on that one, I guess, unless anyone has more.
No, it does not. That's another big pro, that it does not have monthly mortgage insurance. So your rate is your rate, and that's it. It's outstanding. Even though it goes up to 100%. They'll finance all of your home. You do not have to pay monthly mortgage insurance.
Perfect.
Yeah.
Cool.
Thank you guys. Yeah, thank you
thank you,
Verner, for putting this on, and everyone else for attending and the questions.
Yeah, I really appreciate it, guys. I really appreciate your time. Most importantly, it's very valuable. If you have any more questions, please reach out. My information is there. Verner Dixon, 858-847-5500. homesbydixon@gmail.com. And David Boubion, 619-540-8473. David@c2homelending.com. The winner, I had a giveaway on Instagram is Kylie Chilton. I'll send you your $50 DoorDash gift card. Thank you so much.
That's awesome.
And yeah, if you guys have any more questions, feel free to reach out to us individually or together.
Yeah, anytime.
All right. Thank you, guys.
Thanks, guys. See ya.